What's up, guys? I'm back here with another one. So recently I did a suggestion poll on my Instagram, and I asked the kind of YouTube that you guys will want me to do next, and majority suggested with Fibonacci retracement. So that is exactly what I'm going to do today. This is a very short video. I'm going to make it short so that it can just go straight to the point. You know, sometimes talking so much will contradict things that would have rather been meant to be simple. So I'm going to do just a simple analysis on how you can use Fibonacci retracement actually to create your point of interest. So one of the uses of Fibonacci retracement is to use to measure probably where the retracement, or rather pullback, is likely to fizzle out. So what do I mean by that? The market structure, we know that it moves by, for example, it's an uptrend, higher highs and higher lows. And for those higher lows to be created, there has to be some retracement or some pullback, which have to be created so that the market can keep on forming higher highs and higher lows up to certain maybe supply level, so that we can expect another maybe bearish move. So that is one of the uses to measure where the pullback or retracement is likely to fizzle out, or rather to end, so that you can kick in and continue with the move. So another use, which is not use maybe many people, is Fibonacci is also used to place a take profit level. You know, sometimes you might enter at several entries, and one of the entries you might put your TP1 or rather TP2 at the Fibonacci 50 level. Some other people use like that, but I'm going to use in this case Fibonacci to create a point of interest. That is what I believe majority of people meant when I did that quick poll. So in front of me is volatility 151s. So V51s, if I just maybe clear everything and then we do a top-down analysis together, and I show you how I've used my Fib tool to create these point of interest that I currently have on V51s. So if I go to the weekly time frame quickly, you'll see that V51s have been having a strong bearish move for a very long time. V51s since maybe 2022, as I can see from my data here, the 51s have been moving down. So, and if you zoom in a little bit, I don't know if you're able to see, you realize that right now the market is behaving as if it wants to go up. We don't know for sure if this is going to be a swing move, but at least let us speculate that this is the most recent low high that the market might want to probably mitigate on the 51s. So as of now, we are expecting probably some up move up to that level, which is the most recent low high. Because if I go on, you can see this, there are other low highs in the past that the 51s have been creating, like that. Maybe I switch to the line graph to make it a little bit more clear. So 51s have been creating lower highs and lower lows like that. So, and we know that in a downtrend like this, we are waiting for the market to mitigate the most recent low high, so that probably you continue with that same move. So let me now, I'll remove these other highs because they are not of important. The most important one is this most recent low high. And right now you can see for the past like 4 weeks, probably 1 month, the market is seems to be shifting the momentum from this strong sell move, and it seems to be buying. You can see the nature of this past 4 weeks, the nature of the candles, the way they look like. That selling momentum is no longer showcasing. So you might speculate that the market might as well want to mitigate that most recent low high. If not at all, there is going to be a strong bullish move. So those are two of the probabilities. Probably a very strong bullish move, because remember, we are on the one of the lowest point V51s that have been there, and we know that the more the market keep on pushing down, the more you might expect a very strong bullish move, because you know the law of supply and demand, right? Okay, so I'm going to narrow down to the lower time frames, and we see what is happening probably on the daily time frame. You will see, if you're very keen here, you will see the market is forming higher highs and higher lows in that nature, and is going up like that. So that is a sheer indication that indeed the market wants to produce some buy move, and we have anticipated, or rather we have speculated, that the market is probably going to generate that move up to this level. We don't know for sure if from this level the market is going to break and go up, or is going to go down from there. So on this level, I first of all I realized that if I place what I call levels of sensitivity somewhere around here, you realize that. So remember, this setup, you don't just create with one, considering one factor. You have to put at least 3 confluences so that you can be convinced that indeed this is a good setup. You have to understand that. You don't want to see like maybe an order block and then now you're saying that, okay, let me wait for this order block. That order block has to be an order block with release, an order block that cause a break of structure, probably something like that, so that you can be convinced. So even if we are saying that we are going to use a fib tool, we are going to use a fib tool just as a confluence, but we are going to consider other factors, like for example, line of sensitivity and order block. Was there a fair value gap there? Such things, when you combine and then you find that that area has contained all those things, then that becomes an area of interest. So it is very simple to come up with a setup when you consider several things like that. So when I place this, so I'm going to explain how I came up with this setup. So when I place this line here, first of all, I switch the line graph and I see the market is moving high like that. Okay, so on the first of all, I consider this as the most recent lower high in terms of the daily time frame. This was the most recent lower high over here. One might be asking, okay, so over here there is this one most recent lower high on the daily time frame. So when I switch back to the line graph, I realized that also around that level, there is this order block over here. There's this order block on the daily time frame over here that now these are things that's coming up together. And when I place this yellow line over here, you can see in the past there was a reaction from there. Remember, there's a daily time frame. So a touch in that line and then a move like this, that means there is a lot of sensitivity around that level. Again, so this is past, you can see over here. Let me use this arrow. Past demand level caused an up move. The market came back here, formed a supply level from that line. The market touched the line and went down again on the daily. So what does that mean to you? It means somewhere around that line, there's a lot of orders that are being placed. And that is why when the market, every time that is that line, it tends to change the direction. So, and by the way, before I continue, in terms of the market structure as well, you can see when I switch the line graph, you realize that apart from us saying that the market is likely to go up for some time, you realize that on the daily, we have already formed a double bottom. Okay. So, and we know other people call it M formation, double bottom, all those things are the same. So let me remove this one so that I can explain something here first. So we are trying to see the narrative where we can find a point of interest. So first of all, we have seen a double bottom, and this double bottom, after that, we can see what we call the neckline has been broken, and our line of sensitivity is an area where we call the neckline in this case of ours. Reason being, the neckline, let me explain. After the market has formed this double bottom and break that double bottom, so at this middle of that like for example that W, maybe that middle area is where now in our case also our line of sensitivity lies there. Understand that? So this it starts now, these things have started now making sense on why we are going to go up in terms of this market. Double bottom, the neckline have already been broken. So what are we doing right now? We are probably waiting for a retest of that neckline, and then we place our buy position from that level. Okay, so I'll go to the H4 and we see around that neckline what is there again. So when you go to the H4, and by the way, before I go to the H4, on the daily, around that neckline, we have a fair value gap. Understand? This area is a fair value gap. So a fair value gap basically is where there was a price inefficiency. Let me put it that way. There was an imbalance somehow like that. Like there were more buyers in our case, for example, that generated a very strong move that left a fair value gap. So what happens is at some point in future, that fair value gap must be refilled. It may not be today, it may not be this year, it might be even, I don't know, so long from today. But one thing with the market is that it must refill those fair value gap. If you backtest enough, you realize that those fair value gap market tend to refilling them as it continues moving in the future. So on our daily, also around our neckline level is our fair value gap around that level. So let's go to the hedge fund. We see that neckline, that fair value gap, what exactly is there. And when you go to the H4, something beautiful as this order block is there again. You can see. So this was fair value gap on the daily time frame. This is that neckline that we are talking of, that W formation on the daily time frame. And then now when you go to the H4, you see an order block. So I hope you can see that order block over here. It generated a very strong buy release from there. So what does that mean to you? And then before even conclude, if I stretch to the left, this zone, you realize that this is a zone that market has been touching and there has been reaction from here. So let me put it precise, just a minute, like that, okay? So this is a zone that the market has been touching, and then we have been having a reaction from there. Understand? So so to increase our confidence on how I use my fib in this case, is that I pull from where the market originated and from where the retracement has started. So probably you're expecting probably this retracement has started from here. So, and if you check where this move originated from, with regards to our zone where we have seen there was a fair value gap on the daily time frame, there is an order block on the H4 time frame, there is also a level of sensitivity, rather a neckline, you'll be able to see that along all those conferences, that zone still lies at the 61.8 Fibonacci level, or rather that zone is between the 50 and the 61.8 Fibonacci level. So that is this is one of the setup that has been intertwined, or rather it has the confluence with other point of interest the way I create them. And I saw a fib also fitting very well, because our zone of interest is also at the 61.8 Fibonacci, or rather the between 50 and 61.8 Fibonacci level. So so I hope you have seen how you can easily use a fib to increase your confidence while creating a point of interest. So this video is, as I said before, is going to be just a short video, but I just want you to get that point very clear, because sometimes when content is short, it tends to give information to the point. So as you can see from our zone now, from our zone, 68.8 now is where probably you're waiting for the market to come back there. If the market will do justice and come back to that 58.1 level, we can now be able comfortably, after considering all other factors, we can comfortably place buy positions after seeing our entry confirmation as well. You know, the entry confirmations are very important. And now maybe we might anticipate, maybe our TP1 might be this level, this previous structure level, and the market, if the market will break this level, then for sure a retest of it can take us to this zone that we have seen is the most recent lower high on the weekly time frame. So after I do that, I've created my setup like that. I'm now patiently waiting. So here is where now why even if you go to all YouTube channels, you will hear traders saying you have to be patient, because now remember, one candle here is taking 4 hours to form. So probably even a whole day I might be waiting for my setup. But one thing with trading is that you don't need to trade every day. You just need to create good 2 or 3 setups in a week, and then you are done like that. So that is one of the effective ways that you can use a fib, just to bring in confluence in your point of interest. So I've created now my point of interest, and I'm now patiently waiting for the market to come back and mitigate it. That's so remember, one thing in trading is that nobody's control the market. So it might as well never come back there, which is okay. But if it comes back, there are all reasons in this world to place a buy position. So yeah, that's it, guys. I just wanted to show you how you can use fib to measure where retracement is likely to fizzle out. And now you jump in to the setup. So I hope you will find the content well with you. So thank you so much, guys. That's it. Until next time.